American Independent Marketing. Happy Friday, as some people say. Just wanted to say good morning to everybody and announce that we are having this webinar today with Mutual of Omaha and United of Omaha on their life products. And today we've got a special guest, Sandy Petrie. She's a director of the life sales and brokerage, and she's been with Mutual and United for years and years. And I just want to make a couple of comments before we pass it over to Sandy. Here at AIM, we've been primarily a long-term care shop and do a lot of other types of products. But in the last year and a half to maybe 2 years, we've been getting a lot of requests for life. And it's actually started to escalate quite a bit more each year that we've been getting involved with life. And especially this year, there's been a tremendous interest in final expense and term products. And there's a new product, and I guess it's really not new, but there's been some additions and changes to this product that we're going to talk to today on the Universal Life with United of Omaha. And so I was talking to Sandy and said, let's put this thing together and get it in front of the producers out there, because I'm sure as we're speaking today that there are people that get sent things on this and they just aren't aware of the competitive area that United has in this area. So what I wanted to do is to have this webinar and give you guys a chance to learn a little bit more about it and ask questions. So again, as we go through this, you'll be muted. You can ask questions by typing in questions, or at the end I'm going to open up the phones. If we don't have too much disturbance with loud noises and stuff, we'll ask questions, and you'll have that opportunity to ask further questions. So with that being said, Sandy, I'd like to pass it over to you.
Great. Thank you very much, David. I really appreciate everyone's time today. I know time is valuable, and again, I really appreciate you taking your time to spend with me today. So what I want to cover today is our Guaranteed Universal Life and Guaranteed Universal Life Plus products, and review in some detail the value that our accelerated benefit rider and the guaranteed refund option rider can add to your clients' coverages, and then also talk about our Term Life Answers product and the great conversion privilege that that coverage has to offer. So first of all, let's talk just a little bit about the Guaranteed Universal Life product itself. This is permanent coverage that is guaranteed to age 120 as long as the client pays their target premium. The product is flexible, meaning that the product can be illustrated to show lesser guarantees, or what we refer to as a dial down. For example, the client can dial down the guarantee to, say, age 105 or 100, or even lower if they want to. The premiums are very competitive for ages 45 to 75 for both males and females. And we're also competitive in our standard tobacco rates for both male and female. So keep that in mind when you're looking at this coverage. Think of Universal Life as the middle ground between term life coverage and whole life. It does cover them for their whole life, but it can be tailored to any period that they want. So longer than a term life would be able to be guaranteed too. So keep that in mind. And keep in mind also that the premiums are going to be right in the middle between the two. All right, now at the end of 2014, we changed the accelerated death benefit rider to provide additional benefits to our policyholders. Now this rider has two parts, an acceleration for a terminal illness and also an acceleration for a chronic illness. For terminal illness, the client can accelerate up to $1 million or 80% of the face amount, whichever is less, if their life expectancy is 12 months or less. Now that's added to all the policies at no additional cost to the policyholder. Now the acceleration for chronic illness, if the client is unable to perform 2 of the 6 activities of daily living, they have a severe cognitive impairment, they can accelerate up to $1 million or 80% of the death benefit, whichever is less. Now, again, this acceleration is kind of built into the coverage. There's no additional cost for this. And as you can see, based on the 2 of 6 ADLs, in order to accelerate, it acts a little bit like a long-term care coverage. Now let's look into just a little bit more detail of how this works. All right. In this example, we have a person, let's just call him Bob. He has a policy, a $500,000 universal life policy. So he is allowed to accelerate 80% of the policy if he should have a chronic illness. So in total, he can accumulate up to a maximum of $400,000. So let's say he does have a chronic illness and he requests an acceleration of $100,000. So what we do is when we get that request here into the home office, we apply an actuarial discount to that request. And what that actuarial discount is, it's the Moody's corporate bond yield, or 6%, whichever is less, and we multiply that by the current life expectancy of the individual. So in this example, let's say the corporate bond yield is 4.5% multiplied by 3 years life expectancy. That is $13,500. So that is the charge for accelerating. Okay. There's also a flat $100 charge. So what the client is going to receive is a lump sum check for $86,400. Now, they can do whatever they want with this money. They don't have to show proof of long-term care expenses. Again, they can do anything they want. In this example of Bob, his wife was able to take a leave of absence from work to care for him. So say her salary was $64,000 per year. Take that money, that's going to supplement her income, so she's able to stay home and take care of him. They can take a vacation if they want to. Doesn't really matter. They can hire a nurse, go on a Hawaiian vacation. We don't care how they use that money. They can do whatever they want with it. Now, keep in mind, too, there is still money left if they need to accelerate at a later time. So let's just say 12 months from now they want to accelerate again. They can request another $100,000, and they would go through the exact same process. We apply the actuarial discount and the flat charge, and we give them a lump sum check. All right. So the nice thing about this is that I'd like to look at it as a backup plan. So, you know, I have long-term care insurance. My husband and I, we have shared care, 3 years each. But if I had this coverage, this GUL coverage, covered my life or my husband's life, if by chance, say, for example, my husband used 2 years of my long-term care coverage and I was left with 1 year, I would have this as a backup plan if I needed it. If I needed more than 1 year of long-term care coverage, I could tap into this life insurance policy if I was chronically ill, which you would think so if you're using your long-term care benefits, to help supplement anything else that I might need as far as those long-term care expenses go. All right. Now let's also look at a couple different things with this ABR rider. So with the ABR rider for chronic illness, again, there's no upfront cost because we don't charge for this rider up front. There's no premiums that are withdrawn from the policy cash value or any recurring charges that happen every year. It's just included. So think of it as you don't pay for it unless you use it. All right. The benefit amount is flexible. So the client decides how much they want to request and how often they want to request it. Keep in mind they just can't request it more than, it has to be at least 12 months apart per request. But if they want to request it 1 year, skip a year, 2 years later they want to request an additional lump sum, they can do that. Where if you look at typical long-term care riders that are attached to life policies, the benefit is often predetermined at the time that the policy is issued, and it's typically a percentage of the face amount. So typically 1%, 2%, 4%. Also, there's typically not an option to take a lump sum or to increase the benefit amount. Now let's talk about the benefit period. So I talked a little bit about we can accelerate multiple times. It just has to be no more than every 12 months during that acceleration, and again, it's at the policy owner's discretion. For typical long-term care riders, the benefit is typically paid out for a set number of months, whether it be 12 months, 24 months, 36 months, etc. As far as the covered expenses go, our chronic rider, there's no restrictions on the use. As in our example with Bob, they can take that lump sum money and do whatever they want with it, where typical long-term care riders only allow the benefits to cover qualified long-term care expenses. Long-term care continuing education requirements are not recovered on our coverage because it's a life insurance policy. It's not a long-term care policy. It's life insurance, where the long-term care rider, there is going to be state-specific long-term care continuing education. Now, when we look at the underwriting for this, we underwrite for the life insurance policy. We don't underwrite for this chronic illness rider. It's automatically added. It doesn't matter to us as far as if the person that would not typically qualify for long-term care benefits, because, again, we only underwrite for the life insurance part of it. If we'll issue the life insurance policy, they will have this rider. Where a typical long-term care rider, it often requires additional long-term care underwriting, okay? And then with our coverage, again, it doesn't matter what the risk class is. If they're issued a policy at Table 4, Table 8, they're going to get this coverage, where often long-term care riders are not available for people above a Table 4, for example. So keep that in mind. Okay, so not only does this coverage have this valuable benefit with the acceleration rider for terminal and chronic illness rider, it also has a rider that's called a guaranteed refund option rider. Again, this is a no-cost rider. We're adding value to your client without increasing the cost. What this rider does is this rider provides the policyholder with the ability to fully surrender the policy for return of premiums. Okay, so the way that works is at year 15, they can request to terminate their coverage, and they will get 50% of their premiums back. If at year 20 or 25 they want to surrender the policy, they will get 100% of their premiums back. So the way this works is there's a 60-day window at each of those years. So in policy year 15, 20, and 25, the client just has to notify Mutual United of Omaha that they want to surrender their policy for the return of premium, and we will just give them their premium back. Now there is a couple twists to that. That premium refund is capped at 35% of the face amount. So for example, if they had a $100,000 policy, the maximum premium that we will return would be $3,500, all right? That really doesn't come into play very much unless the client is rated so they're paying a higher premium than some of the younger clients, or they're at older ages. That could come into play. Also, with this coverage, if the client is substandard or uses tobacco and they're under age 50, the guaranteed refund option rider is not included with their policy. Also, if they are table rated, Table 5 or higher, and they're over age 50, it's not included. they must maintain a dial equivalent to 100. So what that means is that if they illustrate the coverage to be guaranteed to age 100, they're fine. They're going to get this rider as long as they meet the other eligibility requirements. If they illustrate this policy to be guaranteed to age 90, they're not going to get this rider added to the coverage. All right. Now, at any time, if the client loses their eligibility status, meaning that their guarantee drops below age 100, we will give them a 60-day window to make some additional payments to get that guarantee back to age 100 so they don't lose this guaranteed refund option rider, okay? Now, this statement, no short pay restrictions. I didn't really talk about short pay, so let me review what that is. A short pay, all that is that you're illustrating the policy to pay the premiums for a certain amount of years, but yet your coverage is going to last you for whatever you illustrated. So, for example, let's say you have a 45-year-old client. They only want to pay premiums for 20 years because they plan on retiring at age 65 and they don't want to pay premiums anymore. But they want their coverage to be guaranteed to age 120. Our illustration software will allow you to run that illustration. So it'll tell them what their premiums they have to pay from years 1 through year 20, and then the illustration will show them that their coverage still is guaranteed to age 120. So even if you illustrate the policy that way, you can still get this guaranteed refund option rider. So it doesn't matter if you pay a short pay, even if you pay a single pay, it doesn't matter. This rider is still applicable. All right. Now I want to show you what an illustration looks like that shows the benefit amounts for this guaranteed refund option rider. So on the actual illustration, you'll see the riders and the explanation of the rider. It will list out what the guaranteed refund amounts are in year 15, 20, and 25. So your clients will know exactly what premiums they will get back. All right. Now you might say, why would this be a benefit to someone? They purchased the life insurance to cover them. There's a couple different reasons. Maybe somebody purchased this life insurance to cover some type of outstanding loan or debt that they were obligated to. And then maybe that obligation no longer existed. Who knows? Maybe they had this as business insurance, and then they sold the business and they no longer needed this coverage. So instead of just surrendering the policy and not getting anything out of it or very little cash value, they can use this refund option to just get their premiums back. All right? Okay, so with our guaranteed universal life policies, think about it this way. Think about the value that this policy has. It's a life insurance, so it covers that person if they should pass away prematurely. I mean, they purchased this life insurance to cover them, to help protect their family, to help pay the mortgage, the kids' college, anything else that you would purchase life insurance for. But it also covers them if they have a serious illness. If they're become terminally ill and they need some additional cash, they can tap into this policy, pull that cash out of the policy, and use that money when they need it the most. Also, with a chronic illness, you never know what's going to happen if they do become chronically ill, unable to perform those 2 activities of daily living, say they don't have long-term care insurance or they want to supplement the long-term care insurance that they have. They can use this policy to do that. They can request an acceleration once every 12 months. Take that money out of the policy to help pay for their expenses or whatever they want to use it for. But the beauty of this coverage, too, is that it also provides liquidity. So if they no longer need this coverage, they can surrender it and return a premium. Or if their needs change, maybe they're in a severe financial hardship. Maybe they just need the cash. They can surrender it and get their premiums back. So all of those are at no additional underwriting and no additional cost to the client. So tremendous value with this policy. Now, our guaranteed universal life coverage is available in all 50 states. All right. When we look at the rider availability, the acceleration for terminal and chronic illness, it's not available in California or Connecticut. We have the old versions there. And when you look at the guaranteed refund option rider, it's available in all states except for New York. All right. So we have filed in those states. We're just waiting for approval. Now I want to talk a little bit about one of our other coverages.
Sandy?
Yes.
Just real quick, I don't mean to interrupt, but
That's okay.
In New York, are we using Companion for this product?
You're correct, yes.
Oh, okay. Just so that everyone understands, Mutual of Omaha has several companies they own. And to do business in the state of New York, you have to have what they call a brick and mortar. And their brick and mortar is Companion Life. So the product that you would be using in New York is actually Companion Life. Same product, basically, maybe some minor changes, but it is Companion Life. If you want to expand on that, Sandy.
Okay, yes, you're exactly right. Companion Life is our New York company. It's just look at it as, you know, if you're writing life business in New York for a Mutual of Omaha company, the underwriting company is going to be Companion Life of New York. All the other 49 states are United of Omaha, and both of those are Mutual of Omaha companies. Okay. Okay, let's talk a little bit about our Term Life Answers product. This product it's a fully underwritten term coverage, so not anything too new there. I mean, it comes in 10, 15, 20, or 30-year terms. The nice thing about this product is we just repriced it so that we are very, very competitive in the 10, 20, and 30-year product when you look at an age last birthday. For the preferred plus risk class, preferred risk class, and standard risk class. So I think if you look at our premiums there for both male and females between the ages of 40 and 60 on an age last birthday, you'll find that we are pretty much right at the top there. And what I mean by age last birthday is we look at somebody at their actual age. If they're going to be turning 45 next month, we still consider them to be 45, where some of the other carriers would consider them to be 46. All right? So when we're looking at the Term Life Answers conversion privilege, this is one of the things that sets this product apart along with those competitive premiums, is this conversion privilege. A lot of people just overlook this when they're talking to their clients about term life because they think term is term is term. There's nothing different, nothing that sets it apart. But that's not necessarily true. This conversion privilege is probably one of the most liberal out there in the industry. So, for example, if they have a term life 10, a 10-year term policy, they can convert that policy before age 75 or during the first 2 years after the policy is issued, with whichever is later, to any permanent coverage that United or Companion offers. So they're not limited to a single product that might not be very competitive, might not have very good riders or features. It's any product that we offer they can convert to. For the Term Life 15 and 20, they just have to convert before age 75. For the Term Life 30, it's just during the first 20 years. The nice thing about this conversion privilege also is that they can convert part of it, part of their coverage, all of their coverage. They can keep part of their term coverage in force. Let me give you an example. Say they have a $500,000 life insurance policy, term life policy. they want to convert half of it to permanent coverage, they can do that using our most competitive product, even this GUL that I was just talking about. They can also keep the other $250,000 in the term coverage if they want to, or they can cancel the term coverage, whatever they want to do. The nice thing about it, there's no additional underwriting. So they just tell us that they want to convert it, and we go ahead and convert it. So there's no parameds, no exams, nothing. Also, as long as the coverage has been enforced, the term coverage has been enforced for 1 year, then we're going to pay first-year commissions on the conversion, all right? So think of what a benefit that is to your client. Say you have a client, maybe it's a newlywed couple, they're just married, they just bought their first house, they want to start a family, so they don't have maybe a lot of money at this point, but they need some coverage. So term is definitely the way to go with that to get them the coverage that they need. And then later on, you know, when you're reviewing their coverages with them 2 years down the road, 3 years down the road, if their financial situation has changed and they want to convert some of their coverage, they can. They don't have to go through underwriting. So that's the beauty of this, is there's no underwriting on the conversion. They can convert as much as they want. And if it's been at least 1 year, the agent is going to be able to get a first-year commission on the conversion as well. So again, tremendous value with this product. David had mentioned also just a little bit about our Living Promise product. I don't have any slides with that, but I'll just mention briefly what that is. That is our simplified issue coverage that's really intended for final expenses because it is small face amounts, anywhere from $2,000 is the minimum up to $40,000. It's available in a level death benefit or a graded death benefit, and the application will determine pretty much which product the client qualifies for, and there's 10 health questions on the application. So very simple to apply for and for the to get issued. All right. So David, with that, I will go ahead and open it up for any questions that the group might have.
Okay, Sandy, thank you very much. And probably everyone will get a kick out of this because Sandy doesn't really know this, but I think I'm going to talk to her about doing a webinar on that Living Promise here in March sometime, since we're turning to March in a couple of days. So keep your eyes out for a webinar on that Living Promise. I'm telling you, it's very, very competitive, and they are really picking up on that product. There were a couple of questions, and just a note, I'm going to ask those questions for you, but I'm going to unmute the phones here as we get closer here. If you didn't put in the PIN number, then I cannot unmute your phone. So if you're unable to ask the questions because you didn't put the PIN in there. With that being said, there was a question, how do you determine life expectancy on the Chronicle rider?
Okay. Okay, yeah, very good question. So if the client is requesting an acceleration, that information goes to us, our claim department. We have medical doctors on staff, so they will look at the client's medical records, actually, to determine their life expectancy.
Okay, and then someone asked they wanted to see the sample page again, and what I think for everyone is I've got a copy of this presentation. Two things is I can send you a copy of the presentation, or we're recording this seminar. You will find it on our website. So we do record these so that you can listen to it again at your own leisure. And you just, another one was a copy of the PowerPoint. What conditions defined as chronic illness?
We don't look at it as conditions. We look at it as just unable to perform 2 of 6 activities of daily living or severe cognitive impairment. and that is determined by their physician. So.
Okay. The difference between the GUL versus other options.
Okay. Other United of Omaha options, I'm assuming, when
Yes.
I'm answering this question. So we have numerous universal life policies. GUL is just one of our most popular products. We have a GUL Plus product. The only difference really between those two is how they illustrate. And what I mean by that is the premiums when you're looking at either paying a single pay or a short pay or dialing down. It really just depends on how your clients want to pay the premiums as to which policy type that you would choose. And the best way to do that is to just illustrate both, because you can easily just toggle between both products to see what the premium differences is on both of those. We also have a Express GUL product. So that is simplified underwriting. Again, very limited questions on the application, but keep in mind with that one, since it is limited underwriting, the premiums are going to be higher. So it just depends on what your client is looking for as far as which universal life product you would choose.
Okay. And this kind of goes into this last question. Can you download the software for illustrations?
Yes, absolutely. From our Mutual of Omaha website. So it is the broker portal, which we call Sales Professional Access. You can get there if you have not already registered for that site by going to www.mutualofomaha.com/broker. And once you're on that page, there is a button to register. So click that button. It's going to ask you to enter your registration key. All that key is your 7-digit producer number, starting with the leading 0. And then it'll walk you through how to register for that site. And right there on the site then is a download button for the software. And if you have any troubles doing that, you can always contact our sales support unit. And that number is 800-693-6083, and they can walk you through how to do that.
Okay, thank you. Conversion option. Are there any premium credits?
Not sure what they mean by premium credits, but so I'll just talk in general. If they are paying their term life coverage premiums and they convert to another type of coverage, they don't get any type of a credit for those past premium payments. It's like starting a new policy over again. The benefit is they don't have to go through underwriting. So if their medical condition has changed, sometimes that happens. Maybe somebody is perfectly healthy at age 25, but maybe they develop a condition 10 years down the road that would lead them to be uninsurable. That's a reason why they would want to have that term coverage. So to think about it as starting new coverage. When you convert it, you just don't have to go through underwriting.
Okay. Is the term life answers available to age 75?
Term life answers, it depends on which term that they choose. So let me just look here real quick. The term life 10 is available for somebody who is age 75 for both tobacco and non-tobacco. So they could not get a term life 15, 20, or 30, but we would have the 10-year term available.
Okay. All right. Would a client with fibromyalgia qualify for either product?
Okay. Fibromyalgia, we have this nice little underwriting booklet that has some impairments in there. It also has some height and weight charts on that. So if you don't have one of those, certainly contact our sales support unit too, and they would be able to get you one of these. As far as fibromyalgia goes, at this point that is not in my underwriting guide. But what you could always do, again, is to contact the sales support unit, and they would be able to get you over to the underwriting queue. And what they can do is just ask those questions about certain medical conditions, and they will tell you how the underwriters feel about those conditions and give you a range. They would say, oh, that's going to be between standard and a table 4. So they can't give you, of course, the exact table rating unless they look at the medical records, but they're very good about giving you a range, okay?
And Sandy, to expand on that, do you have the number to call underwriting and what extension?
The best number to call is, yes, I do. You can always call the sales support unit to get there as well, or if you have any questions from the underwriting team, you can contact 800-775-7896, and they will be able to answer any underwriting question that you have.
Okay, another question. This was answered, but you might have got on the phone late. The issue age on this product again?
The issue age on the Guaranteed Universal Life product is 18 all the way up to 80 for all risk classes. And if they're above 80, it's only the standard risk class that they will be eligible for, 81, 85.
All right. We had a big meeting today, or a good-sized webinar, so the questions continue on. Did I understand the age was only 40 to 60 on the term?
Actually, what I was illustrating there is that is where we're most competitive. So when you're looking at our premiums, we're going to be the most competitive between the ages of 40 to 60. It doesn't mean that we're not competitive, outside of those ages, but we're just probably going to be at the top. I mean, the very best pricing for those ages.
Okay, thank you. There was a question about California. Are you providing a refreshment to this webinar? Again, it will lay on our website. All you have to do to go to www.yaim.com, go to our calendar, and you'll see our recorded sessions that we have on our webinars, and you will be able to listen to that. Does one have to be LTC facility to be in an LTC facility? I think we answered this question, to accelerate the chronic rider.
Okay, yep, the answer to that question is no. They just have to be unable to perform 2 of the activities of daily living. So if they, or severe cognitive impairment, so if they meet that qualification, that's all that we required, and they can accelerate and use that money for whatever they want. If they want to hire somebody to help them in their home, they can do that, or whatever they want to do with it.
Okay. Is the GUL a new product in California?
It's not new in California. We've had that product. This is a product that's been around for numerous years. Of course, we are continually tweaking the premium so that we can be the most competitive and adding additional riders to this coverage, just as we've done with the ABR rider and the guaranteed refund option rider. So no, it's been around a long time.
Okay. Is the premium for the GUL guaranteed for life?
Yes, it is.
Okay.
So
and
let
go
me
ahead.
expand a little bit about that. The way you illustrate universal life policies, typically is you illustrate it to pay like target premium. So think about it as just like term premiums. You're going to pay a set amount each month, and that's going to cover your premiums for that amount of coverage for as long as you pay your premiums. You're going to have your coverage.
Okay. How soon after issue can one access the chronic illness rider?
Okay. So they do have to be impaired or unable to perform 2 of the 6 activities of daily living for 90 consecutive days. So it has to be at least 90 consecutive days, after the policy is issued, and they can access the acceleration.
Okay. Here's an interesting question. Does the GUL come with a chronic illness rider if it's from a term conversion?
Yes, it does. And that's one of the nice things about our Term Life Answers product is that, we don't underwrite for that. We can just convert it. So if you have somebody who has our term coverage, maybe they have a 30-year term coverage that they've taken out 10 years ago. Maybe a few years from now they have a serious illness that would render them to be qualify for this chronic rider. They can convert. They convert that Term Life Answers to the GUL, and yes, that rider is included because we don't underwrite for this rider. We underwrite for the life insurance part of it, and with a conversion, there's no underwriting. So very good question.
Yeah. How, we already answered this, how do you get a quote? You can download the software, just call the sales, or go on SPA, and you can download it. Another option is call AIM, and we can get a quote for you, or call Mutual of Omaha, their sales desk, and they can do a quote for you. So you've got 3 options there, either download the software, call AIM, and we can get a quote for you, or call the sales desk at Mutual of Omaha, and they can do a quote. Great ways to get that. Would the quote be available through all websites at this moment? Pretty much so. I don't know if we have the download on our site, but I don't know if we have the software set up on our site, but you can download the software. Let's see. Clarify the accelerated I don't know, V's guaranteed. I'm not sure what that is. Oh, no, accelerated versus guarantee refund percentage.
Okay.
35 versus 80%.
Okay, yeah, two completely different things. Okay, so the acceleration is for somebody who is either terminally ill or chronically ill. All right, so they can accelerate up to $1 million or 80% of the face amount. Okay, so again, we talked about they're terminally ill if their life expectancy is 12 months or less. They're chronically ill if a physician says that they're unable to perform 2 of the activities of daily living, or they have a severe cognitive impairment. And at that time, they can request the acceleration. Now, when we're talking about the guaranteed refund option rider, basically that is just they want to surrender their policy. So they want to end their policy and they want to get back all the premiums that they paid. All right. And they can do that at years 15, it's 50%, at year 20 and 25, it's 100%. Where that 35% comes in is, for example, we will not give them back more than 35% of the face amount if they want to exercise the premium refund option. So let me give you an example. Okay, so say somebody has a $100,000 of coverage, all right? And let's just say for that $100,000 of coverage, say they're older. Maybe they paid in at year 20, maybe they paid in $40,000, all right? So you have $100,000 coverage. They paid on the policy for 20 years, and in total, they have paid in $40,000, all right? But let's just say that they want to exercise their guaranteed refund option. It states that we will not refund more than 35%. So what we're going to give them is $35,000. We won't give them the full $40,000. We'll give them $35,000 because that's the cap. But again, that does not happen very often. The reason that 35% typically only comes into play if, again, the client is older and they're paying, probably more premiums than the average person would, or if they have very poor health and so they're paying higher premiums than the average person would. Okay. I hope
Okay.
that answers your question.
Okay, there are all kinds of questions coming in. So
Okay.
again, what issue age requirement for a person over age 80?
What are the issue age requirements for a person over the age of 80?
Yeah.
And I'm assuming they're talking about the GUL policy.
Yep.
So if they are 81 to 85, the only risk class that we will issue is a standard risk class. Even there, if they're preferred, we're only going to issue them at standard. All right, and only, and it's only like 100,000 or more, but we'll issue it.
Okay. Another interesting question: accelerated benefit. Benefit available in U.S. only?
Yes, it is only available in the United States.
Okay. Sits here, so any term policy can be converted like someone in year 17 of the 20-year term?
Okay, it has to be our term life answers coverage. It can't be any other older policy that we might have had out there. But yes, if they have a 20-year policy, 20-year term, as long as they convert that before they turn age 75, they can convert it.
Okay. Can you 1035 exchange an, let's see, can you, I'm only seeing part of this, so I'm having to click down to see the whole question. So can you 1035 exchange an old IL with no evidence of insurability?
No, you can do a 1035 exchange, so they can take the money out of the old policy and put it into the new policy. However, they have to go through underwriting. It's not a guaranteed acceptance.
Okay. This is a pretty extensive question, so I'm going to step in here and kind of, Sandy, you can put in any little comments on it, but it's a pretty extensive question. Review the advantages and disadvantages versus MOO's traditional long-term care. And let me first say that the traditional long-term care is just exactly what you just said there, traditional long-term care. This has the benefit through a chronic rider that has a little bit different setup on qualifying for the benefit, and once you qualified for it, it doesn't have the restrictions that maybe a traditional long-term care policy would, going through the guidelines of how that policy pays. But if you want to know even further about that in more detail, that's a pretty lengthy conversation, so just give me a call here at the office and we can go through that. That's a very lengthy question.
Mm-hmm. Yeah, and again, it's not intended, this rider is not intended to replace traditional long-term care. It is just another option for your clients. I don't know, you might have come across a client that said, you know, I don't want to pay for long-term care because I don't know if I'll ever use it. This is an option. Or maybe they have long-term care currently, but maybe they have a smaller amount than what they need currently. So maybe they purchased it 15, 20 years ago, and now they're realizing that they need more long-term care, and maybe they can't qualify for it. This is another option for them. So it's definitely not intended to replace traditional long-term care, but it does provide some additional options.
Okay, I think that does it for the questions. Again, if you want to listen to this again, it will be on our website at www.yaim.com. Go to our calendar and then webinars, and you'll find it out there. Now, this won't be on there until later today because we have to load it up on there, but it'll be on later today and then sit there for a while on our website. Now, I'm trying to unmute in case someone has a question live. You certainly can. I'm starting to do it. I'm having troubles to unmuting several of you because you must not have put the PIN number in, but there are a few of you that are still able to ask questions. So go ahead and try to ask a question if you have one, and we'll answer them. I'm still working on it because we have such a big group here trying to open up the phones for people. And I'm pretty close to it. Does anyone have a question they would like to ask Sandy? Still unmuting a couple more. Any questions out there?
Yeah.
Go ahead.
Hello, hi, I'm John in Albuquerque.
Oh, we're getting someone's phone. I think that'll go away. Go ahead, John.
The disadvantage versus long-term care, I think, has to do with return. If a person goes into care, facility, for example,
going to be on
qualifies for care.
Call here. Hey, John, would you call me back on that question, and I'll go through that a little bit more. But we're going to have to shut this down because we're on someone's call. So everyone, thank you very much for attending this. I'm going to shut this down. And anyone's got questions, please call me or send me an email. Thanks.
Okay, thank you.
Hey,